And they did that because they got greedy and aggressive when they could have just expanded the loan term, would have paid a little bit more money, but they wouldn't be stressed out right now. Their personal assets wouldn't be at risk.
Hey everybody, I'm Dave Hathaway, owner and operator of Hathaway Property Management, where we self-manage a 50-unit portfolio with efficient systems and processes. Created this channel to share education about real estate, investing, and wealth. Today, I wanted to chat about the best tax strategies for investors with rental properties. And to do that, I wanted to bring on a guest who's an expert in it. I want to introduce Colin Van Balen as our expert today, as he knows a lot more about accounting, bookkeeping, taxes than I do. Colin, introduce yourself.
Hey, so I'm a CPA and founder of Winstone Financial. My expertise lies in helping real estate investors navigate the often challenging but rewarding financial landscape of rental real estate. My goal here is just to always share clear, concise, and actionable strategies to help you minimize your taxes and maximize your profits. Rental real estate can feel really complex at sometimes, but my goal is to simplify it, make it as easy as possible.
Awesome. I love simplification. Thanks for being here. To get right into providing value to people that are viewing this, we're going to walk you guys through some actionable items. But I first wanted to ask Colin, what are the basics that real estate investors should be doing with their bookkeeping and accounting?
So my first key that you need to understand is you need to understand your cash flow. Real estate investing, it's very simple and there's no reason to overcomplicate it. So the goal is just to purchase a property and charge someone to use your property so that they cover all of your expenses and you're left with some cash at the end of the year. So the first thing you need to understand before you can dive into any of the tax strategies that rental real estate offers is understanding your cash flow. And that means you have to estimate all of your mortgage payments, principal and interest, insurance, property repairs, because those always pop up, and any admin expenses you might incur, which are things like your accountant, lawyer, personal assistant, and software expenses. So ideally, before you would purchase a property, before you make the journey into real estate investing, you want to make a list of all those expenses so you know how much you would need to charge to break even. To be successful around real estate, you have to perform this exercise before you purchase a property. Ideally, you do it once a year for your existing properties so you can always stay cash flow positive. But the most important thing is you have to understand your cash flow before you can take any steps with maximizing the tax advantages of rental real estate.
And just to summarize there, if you don't have a handle on your cash flow or you're not making a net positive cash flow, taxes don't matter because you're just going to be losing money.
Exactly.
No, I like that. Is there any other basics that, let's say somebody that purchases their first rental property and it does cash flow positive, are there any other basics they're going to need to know during the year of like, hey, I need to do X, Y, and Z, so I'm set up at the end of the year to file taxes?
Yeah. So if you have your cash flow positive property, the most important thing is to document. It's very, very hard to take advantage of all the great tax advantages of rental real estate when you are not keeping accurate records. It's also very hard to manage your cash flow when you do not have an accurate and unbiased view of your financials at all times. So just checking your bank balance, like that can work in the short term when you only have a couple of properties. But as your portfolio grows, it gets harder and harder to track which properties are making you money and which ones are not.
What exactly are you looking for in the documentation? Yes, I think documentation is awesome, but is there something specific, that action items like documenting expenses or documenting repairs and improvements, or making sure you're keeping your HUD ones, which are your, when you purchase a property, on file? Is there anything else specifically that they need to document, or I guess it's rents and everything else too, right?
Yeah. So, I mean, at the very basic beginner level is keeping the purchasing document, the HUD, on hand, because that's going to tell you what your basis, your initial basis in the property is. And that's what's going to be used to depreciate the property over 27 and a half years. So that's very important for your accountant to have. The other important ones are just the expenses. So anytime you are doing a capital expenditure on a property, repairing it, paying a property manager, you have to keep all of those receipts, because the IRS loves to audit people that are taking giant deductions and really utilizing the tax code. So if the IRS comes in, asks you for a receipt for this $2,000 repair you did on your property, and there's not a receipt, they don't care if the property looks nice. They don't care if it came out of your bank statement. If there's not a receipt for it, they're not going to let you deduct it, and you're going to get hit with a lot of fines and penalties.
No, I think that's great advice. And I'm just taking notes on the side. So summarize some of these points at the end for everybody. Throughout the year, is there anything in particular that people need to know other than documenting and keeping a record of their expenses, which I think is great?
Yeah. So if you want to take advantage of all the great tax strategies for rental real estate, it's not something that you can just hand off to your accountant at the end of the year, because by then it's too late to do anything, to do any strategies, to implement anything. So you have to keep constant contact with your accountant throughout the year. Tell him your ideas. He'll tell you his ideas. Ideally, you'd want your accountant year round to be doing your bookkeeping, because that way they will always have an accurate picture of what your financials are. And if they're a good CPA, they will provide you with proactive advice. They'll find areas where, hey, you're not expensing this, we could up your deductions. Hey, you're going to have a huge tax hit if you keep doing this. Let's work around this and find a better solution. So throughout the year, you just have to be communicating with your team, your accountant, your CPA, your bookkeeper. You always have to be collaborating if you want to take advantage of these deductions.
Could I almost summarize that? I think that's great advice.
Yeah.
Could I say, like, at least contacting your accountant? I think our process is twice a year that we contact our accountant. Would you say, at the very least once or twice a year in like June?
Yeah.
So you have enough leeway if you need to change the strategy a little bit, or you need to implement something else, spend more expenses. So just a phone call or 2 phone calls a year.
Yeah, just an email checking in, saying this is what's going on. These are my ideas. Send the financial statements if they're not handling the bookkeeping for you, because they can't help you if they don't know what's going on, and they can't help you when it's December and tax season's rolling through and you already missed a bunch of big opportunities. It makes your life harder, makes the accountant's life harder when you're scrambling at the end of the year to pull all of these documents together, looking for last second deductions. It's way easier when you just have a set process going on throughout the year. It's the same thing when you can either keep your kitchen clean and not let the dishes pile up, or you can let them pile up and it's a nightmare to get all those dishes cleaned. It's the same thing with your finances, the same thing with your taxes. If you stay on top of it, it'll make your life a lot easier in the long run.
Yeah, I like that. That makes it a much smoother transition, is what you're saying, at the end of the year, because everything's already done. They already know your numbers, and you go straight into filing taxes. So there's probably a lot less holdups, and you're probably more at the front of the line than somebody that just says, here's my big book of everything. Can you help me?
Paper receipts stapled together. Yeah. If you show that you care about what your finances look like and you are personally being proactive about everything, then your accountant's going to treat you the same way. And with rental real estate, it's a long-term game. It's not a get-rich-quick scheme. You're in it for the long haul. So you might as well set up these processes that you're going to use for the next 20 plus years as you build your rental portfolio. You might as well nurture the relationships you're making with these experts and these specialists, because as you change, you get family, grow older, retire, change careers, it's very important that the people who are on your side know about all these things, because that can change a lot of what your tax impact will be at the end of the year.
Just briefly touching back on documentation, is there something, and I'm curious about your best clients, is there something that they utilize to make it easier for you as an accountant, like Google Drive or some sort of app that you're like, hey, this is phenomenal, you should use this to document? I mean, obviously it would not be the greatest to just send you 1,000 receipts in an envelope at the end of the year, I would assume.
Yeah.
Is there something that
you do have a great process set up where you have everything organized in a Google Drive? He has someone upload it for him because he has a lot of properties, but he has everything nicely organized in a Google Drive. It's listed by the amount and it tells what property it applies to, because we want to apply all of those expenses separately. But there's also a lot of people who don't have that system in place, and maybe they don't want to pay the assistant to upload all these documents for them. So one of the solutions is, if you are working with an accountant year round, what we like to do is we set up a separate inbox and we say, hey, every single time you get an invoice into your email, just forward it to us. Just send it to this inbox. It's a specific inbox, and we just have them forward it in. We upload it through a software that will automatically pull it in to Google Drive, so they'll have access to all their receipts that they need, and we always know what's going on.
I love it. I forgot about that. I know we chatted about that a long time ago, but having a separate email that you just send a picture of all of your receipts to, I think that's freaking awesome. And then you have it, documented somewhere at the very least. Maybe it's not organized, but at least you can go through. And early on, I think it's totally fine early on. Maybe if you have 50 properties or 100 properties, that's probably not going to work, or maybe it does work well.
If you're just one property, you're managing everything yourself, maybe 2-3 properties, a lot of people just send it into a separate folder in their inbox, and that works too, because once again, it's all there. You'll always have access to it, but it's just not perfect for record keeping because they just end up hidden there. But if you ever do need them, you'll know that they're there, and it's a 1-second process to push it into another folder in your inbox. You don't have to download anything. You have to write anything. Super easy. No excuses not to do that one.
Yeah, no, I think it's a great strategy. No, appreciate you sharing. And I don't know if I already hit this, but at the end of the year, is there anything in particular that investors with rental property need to do or need to think about right at the end of the year?
Yeah, there's a big key one, but this is assuming that throughout the year you've been keeping accurate records, utilizing your team of experts. Because if you're doing that at the end of the year, super easy, super smooth. But the big one that you will get asked for, no matter what, are the Form 1098s that you will get from your mortgage lender. These just show how much interest expense you paid, which we can deduct. And sometimes it'll show how much property taxes you paid. And they're just important because that's getting reported to the IRS. So the number we are putting on your tax return has to match that number. If it doesn't match, you'll get flagged. You might get audited. They might not care. But those numbers have to match up, and that's why you're always going to be asked for those. They come in the mail usually, so you have to be on the lookout for those.
I got a bone to pick with the 1098s, and I'm curious what your answer is. I've noticed that on some of the bank 1098s, they don't actually list the 1098s. Are they only required to list mortgage interests and not necessarily taxes and escrow? Because I've noticed that some list all three of those, some only list the mortgage interest. So I have to go back and find out what.
Yeah, if they're paying those property taxes for you on your behalf, it's supposed to be on the 1098. They're not going to tell you what your escrow balance is or how much money you contributed to your escrow, but they will tell you what the property taxes are that you paid that year.
So I've actually had banks, and this is a good one for a valuable lesson for investors. I've had banks that just have the mortgage interest listed on their 1098s and do not have the property taxes or the property insurance on there. So you just gotta know that that's not on there, because I would assume that your CPA is not necessarily always going to ask that question, even if they're a high, A player. Yeah. So you're just going to have to know, hey, I need these two things. And if you don't, then you're missing out on a bunch of deductions. I mean, it frustrated me. I was like, man, and I think it wasn't just one institution. It was two different institutions. And I had to go back and say, how much did I pay in mortgage interest, or how much did I pay in property taxes, and how much did I pay in property insurance? And I would have missed out on probably 10 grand in deductions or expenses. So
the problem with that is, like, once again, if you're just waiting to the end of the year to do all this, you're totally going to miss all your property taxes and insurances that the lender's paying for you on your behalf, but you are paying cash towards. So the solution is either save all those statements, or if you're working with a bookkeeper, CPA, give them access to your lender accounts. You can set up a view only access. You give them your password, but that way they will go and get it for you. You'll keep doing the passive work, searching for new properties, maybe coordinating repairs and improvements to the properties, but you'll have someone in the background making sure that you're paying your fair share in taxes. Like, you're not going to miss the property taxes or the insurance if you have someone going and getting it for you.
Gotcha. I know. And just for everybody to get some of our experience, we use Google Drive. And then at the end of the year, we just have all of our statements for properties that we've sold, for properties that we purchase. And immediately when we actually purchase or sell a property, we send that document over to Colin. But at the end of the year, we have them all filed in a certain folder that the accountant and bookkeeper have access to. Mm-hmm. So, and we just share it with everybody. And just like you said, I think it's in, like, there's a viewer mode and editor mode, and you can change what mode different people are in, or remove access if you're no longer working with that person, and add a new person. So yeah, I think that's super valuable. Is there anything else that we haven't touched upon that investors should just know throughout the year when they're working on their stuff, before I fire some fire round questions at you?
Yeah, I mean, just one more quick one, which is, as you grow, as your portfolio grows, like, we always recommend, if you're taking this seriously, to get a new rental property every year. So if you're doing that, you're adding a new rental property every single year, you're not going to be able to do anything or everything yourself anymore. You're going to need to build a big team that you can rely on, that are experts in their field. Like, you'll want your CPA, you'll want a lawyer, you probably want a property manager to get in between you and the tenants, to help with rent collection and coordinating repairs with the contractors. But throughout the year, you just need to have a cornerstone group of experts to help take the weight off your shoulders a little bit. Agreed.
And I think it also depends on what the real estate investor's final goal is. I usually put it into two different buckets. One is it like, hey, I just want 1 or 2 or 3 properties to be passive income. Mm-hmm. I mean, I think you can run that relatively on your own. It's not too complicated, but if you have the wants to have a few more properties, if you want to have 10 properties, or if you want to scale it into a business like we have, it's definitely super important the way you set it up in the beginning, because if you don't, and then all of a sudden you have 30 or 40 properties and you got to change all your systems around, it is painful. So yeah, it's definitely good if you're trying to do that, a few more properties, and it's not just almost like a hobby is what I consider it. If you only have like 1 or 2 or 3 properties, I think everybody can do that. Yeah. Even if you're not educated very well, you can still just rent out a property or house hack.
Good point. You have to take stock of what you want it to look like in the future. It's long-term game, real estate is. And if you want this to one day be your primary source of income, you want 10 properties, 20 properties, then you will have to consider getting that team. But if you just want to do it for fun, because you like fixing up the houses, you like the little bit of passive income, then you don't need the team as much.
All right, I'm gonna shoot some fire round questions that I'm curious about myself, and I'm just gonna let you field them as the expert. The first one is, when do you recommend getting a bookkeeper CPA for real estate investors? Like in what part of their journey? Is it before they even purchase a property? Is it after they purchase one? Is it after they purchase three? When is your recommendation where you're like, you should definitely reach out to a CPA?
My general recommendation for that is it's going to be different for everyone, but it's just when it starts to feel overwhelming. I know there's a lot of people out there that think they can do bookkeeping themselves. Some of you can, but a lot of people just let it go by the wayside. And it's not until they get a rude wake-up call around tax time that they realize I need a bookkeeper, I need a CPA. Because you'll get blown off by people if your records are out of order. But it's just once it's overwhelming and you dread having to go into your QuickBooks file, or you dread having to dig through all of your receipts, that's when it's time for a bookkeeper. You don't have to have 10 properties. You could have just one. But if you know it's something you're not going to enjoy doing, don't do it. Hire someone else.
Gotcha. And I mean, a huge thing is that I think CPAs, bookkeepers can pretty much pay for themselves. I mean, a lot of times we think of them as an added expense. But I know, at least just the other day, you saved me $650 looking at a double receipt. And then I had to go and reach out to a appraisal company that had just charged us on. They said, oh, this is the appraisal for your property that you guys purchased in Memphis, Tennessee. It's like, funny thing. We don't have any properties in Memphis, Tennessee. We've never put an offer on a property. But the only reason I would have been able to figure that out, because we have a lot of just transactions on a daily basis, and I don't look at every single transaction. I can't, is because you said, hey, what is this invoice? You don't have it saved in the folder. And it triggered kind of a like, I don't know what that is. That's a little bit, but that's just $650 there. But I mean, throughout the year, a lot of times we think, again, that having a bookkeeper or CPA is an expense, but a lot of times they're saving you money. If you miss that portion on just writing off your real estate taxes or writing off your insurance, you could have just paid for your, paid for people with that. If you miss that step on the, so I find it as a good check and balance. But I think it's great advice with when you become overwhelmed. I think that's great advice, Colin. Next question is, how can real estate investors pay less taxes? And this is the moneymaker. This is what we all want to know. How do we pay less taxes each year?
Yeah, there's a lot of answers to this one. So I guess we'll start off maybe with one that I don't think very many real estate investors are taking advantage of, in my experience, and that is the cost segregation. So typically I'm seeing people they have their big property improvements, they're paying 5-10 grand, fix the house. They're just lumping it all in as a property improvement, and it's getting depreciated over 27 and a half years. It's a really long time to get back your $10,000 investment. Well, cost segregation, you hire a professional, they perform a study on your property, and they identify parts of the property that we can depreciate quicker. So things like appliances, furniture and fixtures, plumbing, electrical, fence, driveways, landscaping, all of that can be depreciated at a much faster rate, 5, 10, 15 years for most of these items. And if you believe in the time value of money, you want to get that deduction as soon as possible instead of waiting out into the future, because that's extra money in your pocket now that you can use to keep investing in your properties. And it's also a tax deduction, so who wouldn't want that?
Gotcha. It goes more toward the principle of compounding on your investment capital.
Exactly.
Gotcha. And the only way that you can do a cost segregation is with what Colin already explained, which is great documentation. Am I correct?
Yep. It all flows hand in hand. If you want to take these deductions, you have to keep the documents around.
Gotcha. I can see a theme. Happening. Great documentation builds real estate empires.
Yeah.
any other things that are like any other like one item, or you think cost segregation is the biggest item to pay less in taxes each year?
Well, there's also expenses that are related directly to your properties, the interest, the repairs, and there's also the expenses that you're incurring around your business that most people are not deducting. So, for example, you're driving to your rental property, check it on it, do some repairs, meet the contractor, whatever. You can either deduct the mileage, which I think is up to 65 cents a mile now. You deduct the mileage you drove, or you can start deducting the gas, the repairs on your car, the insurance on your car, the depreciation. You could depreciate your car too if you're using the car enough for your business. So people leave out those personal expenses, and they also leave out the personal expenses they're incurring at home. So you're probably not sitting inside the actual rental property doing all of your research and calling the contractors and looking for tenants. Probably doing that someplace in your home. Well, you can deduct part of that too, your utilities, your phone bill, your internet. All of that can be deducted, and you could transfer some of those personal expenses onto your business return to get a tax deduction from that. If you're using it to make a profit, that's the end goal. If you're using your internet to make a profit, we can deduct some of that. And that's something that rental real estate people leave out because they're not treating it like a business. They're treating it more as a passive investment. But at the end of the day, it is a business that you're running. So you can take these deductions.
No, I love that advice. Does it depend on whether you're a real estate professional or not? I mean,
The
it
real
does not.
estate professional rules apply if you're putting a loss on your tax return. If you're just a regular person, not a real estate professional, there's limitations to how much of a loss you can deduct each year. But if you're posting a gain and your cash flow positive, and we have all these other personal expenses that you've been using in the business, we can find a way to deduct some of that to knock down your tax liability.
Dude, I love it. It's great. It's very valuable. Thank you for sharing that.
No problem.
Now, next question I have for you is the biggest mistake you notice real estate investors make in regards to bookkeeping and accounting. Could be end of the year taxes, but just the biggest mistake that you see real estate investors make.
So, one of the biggest mistakes I see with people in rental real estate making is they are not treating it like the long term game that it is. And what I mean by that is it's not them not taking the proper care of the tax deductions. I'm mostly talking about people who find their heads below water and they have to foreclose on their properties. They didn't consult with the lawyer, so now they're personally liable. So I have a client right now that we are working our butts off trying to save from a big cash flow disaster because they took a 5-year loan on a $2 million building with floating interest rates, and they are personally liable for that debt if they can't pay the interest payments, which are now over $19,000 a month, because they did it with a short-term mindset to fix up this property, get an immediate tenant, maybe sell it immediately. But things change really quickly. Like things will get better slowly, but things get bad very rapidly. So if you're not taking out that full 30-year loan, if you're not forming an LLC to protect your personal assets, those are the biggest mistakes. When people aren't showing due care and they're treating it short term, because we've already seen this year alone how much the interest rates can change and how much the market can move up and down. It's not worth losing your shirt over by trying to get a slightly better deal on a 10-year loan than a 30-year loan. So that's the biggest mistake I see are people too aggressive to make money too quick, and they end up losing all their money as a result.
And just to recap, that was a 5-year adjustable rate mortgage they got into.
Yep.
Okay. And do you have any idea what the rate was when they purchased the property and what it is now?
I know right now it's 10 point, no, it's 12.75%
Holy
right
smoke.
now. Like the interest payments are over $19,000 every single month, and they can't get a tenant, they can't get a buyer. Market's down. No one wants to finance a purchase like that for a $2 million building. And they did that because they got greedy and aggressive when they could have just expanded the loan term, would have paid a little bit more money, but they wouldn't be stressed out right now. Their personal assets wouldn't be at risk. So
yeah, that's such a huge lesson. And I do appreciate you sharing that story.
Yeah.
I mean, it's good for me to hear it. So it's good for everybody to hear it. Like, hey, if you get an adjustable, just paying a little bit extra and to share some experience and some back and forth. I just got a 30-year fixed at I think it was 7.25. I didn't love it, but the property cash flows really well. So it doesn't totally matter that the interest rate is 7.25. I do not like locking in a 30-year fixed. But my other option is to do like an adjustable rate mortgage. And if I do an adjustable rate mortgage, there's definitely, and it can be interest only. There's their own things there.
It's a lot of risk doing that. That's just not necessary.
I mean, it also matters a lot with like the purchase price of the property, because interest is going to come into play there. If it's a huge property, 2 million property, 4 million, 5 million, and you have a 12% interest rate, you're probably grossly negative on the cash flow would be my thing. So there's really nothing you can do but to negotiate a short sale or foreclosure. So I greatly appreciate you sharing that, though. It's important. Take note. As I just took note right now in my mind. I'm sure when it pops up next, I'm like, oh man, I should just go for this 5-year interest only loan. That comment will come back in my mind and go, oh, I remember when Colin talked about one guy got hosed on property.
But you also said a great thing there too when you said property cash flows really well. You could still have a 7-8% loan like that and still be getting the cash flow, still getting a little bit of profit. That's all that matters. People are trying to overcomplicate it, trying to maximize the returns, when in reality, the big returns come from getting that little bit of cash flow every year, holding on to it for 15, 20 years. That's where the cash flow comes into play and how you actually build your wealth.
Yeah. Think long-term mindset. To be honest with you, I mean, interest rates don't totally matter as long as you cash flow, and as long as they're not adjusting, as long as they can't move all over the place. They do matter a lot when they can move all over the place. But if you're making a ton of money and your interest rate's 50%, it doesn't totally matter that your interest rate's 50%. Yeah, people are going to look at you and say, hey, you're an idiot. But if you bought your property at a 75% discount and you have a 50%, and if the property has that much value, there's another lender out there that's going to give you a refinance because it's a great asset. Goes back to the learning lesson of like purchase right. If you don't purchase right, it doesn't matter. Everything else isn't going to fall in place.
Yeah.
So no, I appreciate that. Well, cool. I mean, I guess I'll have one last question about 1031 tax exchanges. And I just want to know if there are any hard and fast rules that we'll say newer investors that own 1 to 10 properties should know about 1031s, when they should utilize them. I mean, I guess you can explain what it is real quick. Okay. And then if there's a kind of a hard and fast rule, like, hey, you should do a 1031 if the property is this value and you have this gain, or you should not do a 1031, if that makes sense.
Okay. So the 1031 exchange is also known as the like-kind exchange. So this just allows you to defer your capital gains by taking the proceeds from the sale of your existing property and investing it in a new property. So there are 2 main rules there, though. You can't just sell your property and then one day buy a new one and hope you don't have to pay capital gains. So when you do this, you normally go through a third-party broker just to make it more smooth, easier. But the first rule is you have to identify your replacement properties within 45 days. You can identify up to 3 replacement properties, and you just need to do that within 45 days. If it's still available, you pass the first step. The next step after that is you have 180 days to close on one of those replacement properties you identified. So if you failed step one, it's already done. You're paying the capital gains on it. If you made it to step two and you're able to close on one of those properties, the new property that you own will now take the basis of the old property. So even though that property is worth $1 million, your tax basis could only be like $200,000. So that's the exact reason why you would want to defer it. So knowing when to do it, you don't want to do it, obviously, if you have a loss on the property, because you're not deferring anything in that scenario. It's also, I call it the pain in the ass metric. Is if you only have 20K in gain, is it really worth deferring that? 20K of 15%, it's not a whole lot. If you're looking at 100,000, 200,000, 400,000, that's when you would want to look into this. So I believe these people can be pretty expensive, and it can be a very time-consuming process. It's also pretty stressful because the properties get bought up and you don't close on them. Depends on how worth it is to you to save that tax to do the 1031 exchange. And you also want to know that you want to keep investing in properties. You might not want this property anymore, but you still want to keep investing. That's when you do it. And the other thing to take note of with the like-kind exchange is it's not literal. You don't have to go from rental house to rental house. You can go from rental house to strip mall to commercial real estate building to some farmland. Doesn't matter as long as you identify it within 45 days that I want to buy that, and you actually close on it within 188 or 180 days, then you can do it. You can also exchange 3 properties for 1 property, 2 properties for 1 property, 1 property for 4 properties. Does not matter.
Yeah, no, that's all great advice. It's all great advice. I appreciate you sharing. I mean, I feel like sometimes people might even get stuck in the 1031 because once you do it a few times, then you have this super low basis in a property. And if anybody doesn't understand that, it's basically if you purchase a property and you only pay 30K for this property that you fix up, and then you sell that property for 100, and then you sell it again, you're basically, if you have a property that's worth $2 million, you still have the basis of that first property that you paid $50,000. So if you sell it at some point, you're gonna have to pay the entire gain on 1,950,000, which is a massive tax bill. So there's a lot of people just get stuck in them, and they don't think they have an option. They're like, well, I just have to purchase. And sometimes that actually can provide opportunity for a seller because they know, hey, this person has to switch out, or else they're gonna pay $500,000 in taxes.
Yeah. The property is serviceable, and there's no pain to you to keep holding on to it. Like, you don't need to put in hundreds of thousands of dollars worth of repairs and improvements to keep it going. And that's worth just doing the cash out refinance if you really want the cash, but you don't want to have to worry about paying the tax from selling the property.
Yeah, it's great advice too. If you refinance, it's not a taxable event. If you sell, it is a taxable event. And if you don't 1031 it, you will have to pay the gains on the property. It's also something to be noted here that it's that I find that there's kind of this marketing faux pas where a lot of times they talk about tax benefits, but it's often just a tax deferral. So you're going to have to pay gains on a property unless you use 1031, but unless you hold that property forever, you still have to pay the gains at some point. So even though we talk about it as a tax deduction, it's really a tax deferral. And it just takes, I don't know, to get your head wrapped around it. Took me a really long time to get my head wrapped around it to go, oh, that makes sense. And to understand basis and whatnot. So I wanted to just hit the summary or the main points that Colin talked about today. And those were, and you can correct me at the end if I'm wrong, Colin. Number 1 was make sure your property cash flows positively. So make sure you're not losing money each month on a property, or else everything else doesn't matter. Number 2 is document everything. That includes your HUD-1s, your receipts, your repairs. Figure out a system to document it. Your bookkeeper is going to need that to properly do your books at the end of the year and during the year if you choose to have a bookkeeper. Number 3 is have at least 1 or 2 phone calls. If you don't have a bookkeeper throughout the year, like Colin suggested, that can just seamlessly do your taxes at the end of the year, have a call 1 to 2 times, maybe March and September, that just say, hey, this is what I got going on. Do I need to shift in strategies, or do I need to think about anything else? Just have 1 or 2 phone calls a year. Number 4 is remember the 1098s from the bank, because those are going to be super important to also document, and they're going to come at the end of the year. And just make sure you save them somewhere and that you don't just toss them out and trash them. Lastly was Colin's huge advice in the fire round of thinking long-term, which I really love. I actually totally love it, dude. Is thinking long-term and not thinking short-term. Real estate is a long-term game. So, and his example was with financing options. So those were the main takeaways or the summaries of the main points we hit. Was there anything that I missed?
Build a team once you get bigger.
Gotcha. Yeah, because that could be another point is as you scale, start to build out your team, especially when it starts to feel overwhelming.
Also, don't forget about those extra expenses that could be lying around, like your internet, utilities, phone bill.
Yeah. So added expenses that we don't think about, including parts of an office in our house, mileage and that kind of stuff. Super important. And hopefully you can consult with either Colin or somebody on Colin's team or your own bookkeeper, CPA, that and just let them know. And they should be able to point out a few main areas that you might be able to deduct.
Yep.
Well, awesome. I really appreciate all of that and appreciate your time, Colin, for chatting best tax strategies. Is there a best place that people can reach out to you, founder of Windstone Financial?
Yeah, I mean, you could check out our website, windstonefinancial.com. If you really need to speak with me, you could schedule a call on the website. It goes right to me. We have a lot of great tools and blog posts on there to give you some more tips. Starting to get Twitter going, so eventually you'll be able to find us there, just at Windstone Financial. But for now, if you need to talk to me, you could just schedule a meeting with me and we can discuss anything.
Awesome. I'll put your contact information down in the description for this YouTube video. And for everybody else, we really appreciate you watching. Hopefully we provided some value in regards to accounting or bookkeeping, or else we didn't do a good job. I think we did. But if you don't mind liking and subscribing to the video, it would be greatly appreciated. And we'll see you on another educational video. See you guys.